Hello students, welcome to EPG Pathshala. I am Dr. Manjeet Singh from Punjabi University Patiala. Today we are going to discuss about a module on the topic Structure of Financial Institutional Framework in India under the paper Business Environment. After reading this module, you should be able to understand the concept of financial sector and its classification, to understand the salient features of Indian financial sector. You'll also be in a position to understand the role played by various financial institutions in the Indian economy. And lastly, you will also be in a position to explain the importance of financial sector for smooth and uninterrupted running of the economy. Now, since the year 1991, the Indian economy has witnessed tremendous reforms in every sector and financial sector with, with more emphasis on financial sector. The Indian economy was going through a severe crisis and was on the verge of collapse. And to overcome this crisis, the government undertook major structural reforms in all the major spheres, be it monetary policy reform, industrial reform, foreign trade policy, insurance sector reform, and so many others in the name of liberalization, globalization, and privatization. These reforms provided strong foundation to strengthen the Indian financial sector. Financial sector plays a vital role in the overall development of an economy. It acts as a channel for the transfer of resources from those who have idle funds to those who need them. That is, from those who have surplus funds to those who are in shortage of funds. Financial sector is the most important transformational engine for the economic development and growth. It bridges the gap between the savings, the level of saving, and the level of investment for creation of new wealth, which is also called capital formation, by transfer of funds from the savers to investors through financial intermediaries that set the pace for accomplishment of broader microeconomic objectives. It acts as a spark in the fire of economic development and growth. Financial sector ensures the adequate supply of funds in the economy to enable full utilization of national resources while keeping check on the price level changes as well. It is a composition of various markets, institutions, laws, and regulatory authorities. Working of financial sector. When we look at the cycle related to the working of financial sector, income generation leads to saving. Savings through the intermediaries are channelized into investment, and investment leads to economic growth, and economic growth again leads to income generation. The process of saving, finance, and investment enables the users of the funds and the lender of funds to exchange funds through the financial sector. So, the financial sector is a sector that enables the smooth flow of funds between the lenders and the borrowers. Financial sector consists of set of institutions, markets, and it also includes the legal and regulatory framework, which is the most important component of the financial sector. A well-developed financial sector is the foundation for the growth and prosperity of any economy. A healthy financial sector is the key element in keeping economy stable. The savings of one sector becomes the source of finance for another sector through the intermediaries, which leads to capital formation, leading to increased national income for the country. The financial sector provides financial services to commercial and retail customers. This sector includes banks, insurance companies, investment funds, and real estate. The part of an overall economy that is primarily made up of banking institutions, brokers, and money markets. The financial sector is a very important aspect of big and highly developed economies such as those in United States, Japan, Switzerland, and UK. Meaning of financial sector. Financial sector is the set of institutions, markets, instruments, and legal and regulatory framework that permits the flow of credit in the economy. This segment of economy encompasses banking services, business, stock and commodity market exchanges, financial and investment services, and mortgage and personal lending. Indian financial sector, the way forward. Financial sector reforms can be categorized in two phases. The first phase of reforms that started in 1985 primarily focused on new technology import, increased productivity, and effective use of human resources. The second phase, that is started in 1991-92, the government aimed at reducing the fiscal deficit by opening economy to the overseas investment. Financial sector reforms during 1991-1992 focused on improvement in the financial health of the entities, creation of a competitive environment, modification of the policy framework, improvement in the financial health of the entities, and creation of a competitive environment. The last decade witnessed a significant expansion in the financial markets with the introduction of products in banking, insurance, several new instruments, and capital markets space. During this phase, the Indian financial sector opened up to new private players, including overseas companies. Financial sector of India, eligibility for government autonomy. For acquiring government autonomy in India, there are certain criteria that are required to be fulfilled. The first is accessibility of total non-performing wealth of below 9%. Secondly, availability of surplus funds up to 8%. Minimum net possessed funds of more than 2.5 million US dollars and net revenues of minimum past 3 years. Financial institutions that satisfy the above mentioned criteria will be authorized for functional independence in almost all managerial areas. Features. First feature is promotion of liquidity. The major function of financial sector is the provision of money at the time when it is required and in adequate quantity to facilitate the smooth production of goods and services. Financial sector ensures adequate liquidity in the economy, which is essential for the proper functioning of any developing economy. Secondly, second feature is that it brings savers and investors to the common platform. One of the important functions of financial sector is to bring savers and investors together to facilitate efficient and effective mobilization and allocation of resources. It gives savers an opportunity to invest their idle savings and earn returns on the same, while at the same time making funds available to those who need them for productive purposes. Third is allocation of risk. Though the risk cannot be eliminated altogether, but the financial sector helps in minimizing the risk. It ensures optimum allocation of risk by bringing it within acceptable limits by spreading it among the large number of people. The fourth is that it accelerates the pace of economic development. Financial sector accelerates the growth rate of economic development as it finances industrial sector of the economy by giving loans, by the way of giving term loans, medium term and short term loans. It not only looks after the financial requirements of secondary and tertiary sector, but also caters to the requirements of primary sector which is dominant sector of Indian economy. Another feature is that it leads to capital formation. As the financial sector mobilizes the idle savings of the household sector and puts it into productive use, leading to capital formation in the economy. Therefore, leading to capital asset formation, which is part and parcel of economic growth. Next is size transformation. The financial sector create large volume of credit from small deposits that is received from their customers of the financial sector. Credit creation is one of the most important function performed by financial sector. It helps in maintaining adequate amount of liquidity in the market all the time. Another is maturity transformation. Financial sector offer their customers alternative forms of deposits and investment schemes according to their risk-taking ability, expected returns and liquidity preferences. And at the same time, it provides borrowers and funds of the required maturity. It also inculcates saving habits among people. Financial sector encourages savings amongst the people by offering them wide range of financial assets according to their needs and requirements. These investment opportunities have led to increased level of savings and increased levels of investment from the same level of monetary income. Saving mobilization. Financial sector is highly efficient system for mobilizing the savings of high household sector. Saving mobilization takes place when the currency, bank deposit, and post office saving are put to productive uses. Sectoral allocation of funds. The financial sector ensures the sectoral allocation of funds on the basis of their priority in the national plans for the achievement of various microeconomic and macroeconomic objectives of the nation. Role of financial sector. It ensures adequate liquidity in the economy. It gives opportunity to invest to those who have idle funds with them. It minimizes the risk of individual by spreading it among large number of people, and by using idle savings in the productive activities, it helps in the capital formation in the economy. Structure of Indian financial system. The Indian financial system can be classified into the organized financial system and the unorganized financial system. The organized financial system comes under the purview of Ministry of Finance, Security Exchange Board of India, Reserve Bank of India, and other regulatory bodies. The unorganized financial system consists of individual money lenders such as relatives, landlords, traders, neighbors, store owners, and so on. It also includes the group of persons operating as funds or association. It also includes the partnership firms consisting of brokers, NBFCs such as chit fund companies, etc. Organized financial system. Components of formal financial system. The financial institutions. Secondly, the financial markets, which comprises of capital market and money market. Thirdly, financial instruments. And fourthly, financial services. Financial markets. Financial markets enable the participants to deal with the financial claims. Money market and capital market, these are the two organized financial markets in India. Money market is for short-term securities, while capital market is for long-term securities. What is capital market? It is that segment of financial market in which securities having long-term maturities are traded, and it is used as a means for borrowing and lending in the long term. Capital market securities consist of equity shares, preference shares, debentures, and bonds. Government and corporate sector, they raise funds to finance its activities from the capital market. Further, the capital market may also be divided into primary and secondary markets. Newly formed securities are bought and sold in the primary markets, such as during the initial public offerings, the new the new shares are issued. On the other hand, secondary markets allow the investors to buy and sell the existing securities. The transaction in the primary markets exists between the issuers and investors, and transactions in the secondary market exist amongst the different investors. Now, what is money market? Money market deals in the securities having maturity period of less than 1 year. It is used as a means of short-term borrowings and lendings. Money market instruments are also or are also can be also be called as cash investment, as they offer high liquidity and are having very short maturity period. It includes commercial paper, certificate of deposit, treasury bills, bankers' acceptance, repurchase agreements, and so many other types of instruments which become part of the money market. Role in the economy. If financial markets helps the economy in the following manner. Saving mobilization. The most important role of financial market is to obtain funds from the savers or the surplus funds from one unit, such as household individuals, business firms, public sector units, central government, state governments, etc. Second is investment. The financial markets plays an important role in arranging to invest the funds. National growth. The financial market is that which is helpful in contributing to the nation's growth by ensuring flow of funds from the surplus areas to the deficit units. Flow of fund for productive purposes is also made possible only through financial markets. Entrepreneurship growth. Financial market also contributes to the development of entrepreneurship by making available the necessary financial resources. Industrial development. The different components of financial markets help an accelerated growth of industrial and economic development of a country, therefore contributing to raising the standard of living of the society. Functions of financial markets. The intermediary functions of financial market includes the following. Firstly, transfer of resources. Financial markets are helpful in the transfer of real economic resources from lenders to the ultimate borrowers. Enhancing income. Financial markets allows the lenders to earn interest or dividend on their surplus investable funds, which is further helpful in contributing to the enhancement of the individual and the national income. Productive usage. Financial market allows for productive usage of funds borrowed, the enhancing of income and gross national production. Capital formation. The financial markets provides a channel through which saving flow to assist capital formation of a country. Price determination. The financial markets play a very important role in the determination of the price of traded financial assets through the interaction of buyers and sellers. Sale mechanism. The financial market is that instrument. Financial market is helpful in selling of financial assets through an investor in order to offer benefit of marketability and liquidity of such assets. Information. The activities of the participants in the financial market are helpful in dissemination of information to various segments of the markets in order to reduce the cost of transaction of financial assets. Financial services. Financial services is the term used to describe the institution and organization that deal with the management of the money. They provide expert advice on financial planning, money management, investment management, insurance plans, dealing in foreign exchange, and many more. Financial services includes hire purchase, credit rating, merchant banking, leasing, hire credit rating, etc. Financial services rendered by the financial intermediaries bridge the gap between lack of knowledge on the part of investors and increasing the superiority of financial markets and instruments. Financial instruments. Financial instrument is a claim against a person or an financial institution for the payment at the future date or the periodic payment in the form of dividend and interest. Financial instruments may be primary or secondary securities. Primary securities are issued by the ultimate borrowers of funds to the ultimate savers, that is, mutual fund units, insurance policies, bank deposits, etc. It helped the financial markets and the financial intermediaries to perform the important role of channelizing funds from the lenders to the borrowers. Financial instruments can be either cash instruments or derivative instruments. Cash instruments are those whose value is determined directly by the markets. These instruments can be securities which are readily transferable, such as loans and deposits, where both the borrower and the lender have to agree on a transfer. Derivative instruments are those instruments which derive their value from one or more underlying entities such as an asset, index, or interest rate. They can be over the counter, that is OTC derivatives, and exchange traded derivatives. Alternatively, the financial instruments may be categorized by asset class depending on whether they are equity based or debt based. Short term debt based financial instrument last for 1 year or less. Cash of this kind can be deposits, and securities come in the form of treasury bills and commercial paper. Exchange traded derivatives under short term debt based financial instrument can be short term interest rate, futures, OTC derivatives, and forward rate agreements. Long term debt based financial instruments last for more than 1 year. Under cash, these are loan, and under securities, these are bonds. Exchange traded derivatives are bond, futures, and options. Over the counter, that is OTC derivatives, are interest rate swaps, interest rate caps and floors, interest rate options, and exotic derivatives. Under equity-based financial instruments, security are stocks. Exchange-traded derivatives in this category include stock options and equity futures. The OTC, that is over-the-counter derivatives, are stock options and exotic derivatives. Financial institutions. Financial institutions are the intermediaries that mobilize the savings and facilitate the allocation of funds in a very efficient manner. Financial institutions can be classified as banking and non-banking financial institutions. Banking institutions are the creators of credit because they aim at credit creation, while non-banking financial institutions are purveyors of credit. In India, non-banking financial institutions such as non-banking finance companies, development financial institutions, as well as the housing finance companies are the major institutional purveyors of credit. Financial institutions are further classified as term finance institutions such as Industrial Development Bank of India, that is IDBI, Industrial Credit and Investment Corporation of India, that is ICICI, Industrial Finance Corporation of India, that is IFCI, Small Industries Development Bank of India, that is SIDBI, Industrial Investment Bank of India, Export Import Bank of India, Tourism Finance Corporation of India, that is TFCI, Infrastructure Development Finance Company, that is IDFC. National Bank for Agriculture and Rural Development, that is NABARD. National Housing Bank. Investment institution in business of mutual funds like UTI, public sector banks, private sector mutual fund companies. Insurance companies and corporations like LIC, GIC, and its subsidiaries. There are some state level financial institutions as well, such as State Finance Corporation, State Industrial Development Corporations, SIDCs, which are owned, managed, and controlled by the state governments. Now let us discuss the contribution of financial sector to the growing economy. Indian economy is considered as one of the top growing economies in the world. Financial services sector is one of the most distinguished sector of Indian economy. Its contribution comes across even more strong when we look at the total number of employment and the tax revenue which it generates. Employment generated by banking and insurance companies every year runs into millions, while employment generation and revenue are two important contributions to the overall economy and is another important contribution of financial sector. Banks and non-banking finance companies in India have just discharged credit in billions to big and small industries, entrepreneurs every financial year. With the superior availability of credit, the Indian economy during the last 2 decades have managed to march towards high economic growth and development trajectory. Now let us discuss about the recent reforms which have taken place for the growth and development of financial sector. The first one is that in 2015, RBI set up the much anticipated payment bank sector. It awarded payment bank licenses to 11 entities. Along with redefining the consumer experience, these banks are further helpful for the growth of financial sector as well as for the growth of the overall economy of India. Secondly, in order to make banks extra credit friendly, the Reserve Bank of India has allowed the banks to raise funds through long-term bonds for financing the infrastructure sector. Thirdly, the government has raised the cap on foreign direct investment in the insurance sector by 49%. Recently, the Indian government started Mudra scheme, under which Indian banks will be providing affordable and cheap credit to the small entrepreneurs, to the new entrepreneurs. So students, now let us summarize what we have learned from this module. As we have seen that financial sector bridges the gap between the level of savings and the level of investment for creation of new wealth, or we can say by ensuring more capital formation, and which is done through transfer of funds from savers to investors through financial intermediaries. It plays a crucial role in the economic growth and development of any economy. It not only extends the financial support to industrial sector of the economy, but it also plays a greater role in the overall growth and advancement of all spheres of the economy. The financial institutions not only brings borrowers and lenders of money to a common place, but also ensures the safety of transactions. The regulatory authorities work as a watchdog to supervise, control, and coordinate the working of these institutions. Specialized institutions like NABARD ensures the growth and development of rural economy and the primary sector, while on the other hand side, IDBI and IFCI cater to the financial needs of large-scale industries. As these institutions are working at the national level, the State Financial Corporation, the State Industrial Development Corporation, they are also performing a similar kind of function at the state level. So we can say that financial sector acts as backbone for the development of economy of any country. Thank you.